One of the most important financial benefits of buying a home and having a mortgage is the mortgage interest expense income tax deduction. For most borrowers, the mortgage tax deduction offsets their monthly housing expense and is an important factor in determining how much home they can afford. According to federal tax code, mortgage interest and property tax expenses are deductible against a borrower's gross income. The lower your gross income, the less tax you pay. Just to be clear, your mortgage interest expense is not directly deducted from the taxes you owe on a dollar-for-dollar basis, but rather reduces the gross income figure that is used to determine the amount of federal tax that you owe. It's important to point out that the deduction applies only to federal taxes and not state taxes. Additionally, you do not receive any money directly from the federal government as the result of the tax deduction benefit. So you do not receive a monthly check from the government for the tax deduction, but you do owe the federal government less in taxes. Also, given how mortgages typically work, it's important to note that for most mortgages, the tax deduction benefit is the greatest at the beginning of the mortgage and gradually decreases over the life of the mortgage. This is because for most mortgages, the portion of your monthly mortgage payment that goes to interest decreases, while the portion of your payment that goes to principal increases over the life of the mortgage. There are also some limits to the tax deduction. For example, if you have a mortgage amount greater than $1 million, the tax deduction benefit only applies to the interest you pay up to a maximum of $1 million of your mortgage. I'm going to walk through an example that shows you how the interest expense tax deduction benefit works. Let's look at a borrower that makes $75,000 a year in gross income. I want to emphasize that this is gross income, so your income before any deductions such as taxes, Social Security, and Medicare. In the first case, the borrower is renting and paying $2,300 a month. In the second case, the borrower has a $380,000 mortgage with an interest rate of 4% and pays $4,700 a year in property taxes. Let's look at the borrower's financial profile both with and without the tax deduction benefit. In both cases, the monthly housing expense is $2,300. In the first case, that's how much we're paying in rent. In the second case, that equals our mortgage payment plus property tax and homeowner's insurance, so total monthly housing expense. Next, let's look at the deductions. In the first case, we have no deductions for mortgage interest or property tax because we're paying rent. In the second case, we pay $14,880 in mortgage interest and $4,700 in property tax a year, so our total deduction is $19,580. So we subtract this deduction from our gross income to arrive at the figure that we will use to calculate the amount of federal tax that we owe. So our gross income after the tax deduction is $55,420. Now we can apply a 20% federal tax rate to the gross income in both cases to calculate our tax bill. So our federal taxes are $15,000 when we do not have the interest expense tax deduction benefit and $11,085 in the case when we do have the deduction. So the tax deduction enables us to save $3,915 a year or $325 a month in federal taxes, which we can use to offset our total monthly housing expense, which is $1,975 when you factor in the tax benefit. It's important to reiterate that the government is not paying you money every month, but by lowering your tax bill, the mortgage interest expense income tax deduction benefit has a positive financial impact. We encourage you to review related freeandclear.com videos such as Should I Rent or Buy, and also check out our mortgage interest tax deduction benefit calculator and our detailed discussion and example of the mortgage tax benefit in the Free and Clear Mortgage Process Guide. Thank you for reviewing Mortgage Tax Deduction Benefit Overview with freeandclear.com. freeandclear.com.